A statement of financial position, often referred to as the balance sheet, is a financial document that provides a snapshot of a business's financial health at a given point in time. It lists the company's assets, liabilities, and shareholders' equity, offering a clear view of what the business owns and owes, as well as the investment made by its shareholders. Fixed assets are resources owned by the business that are expected to provide value for more than 1 year. These include items such as machinery, buildings, and vehicles. For example, a factory purchased by a manufacturing company is a fixed asset, as it will be used over several years to produce goods. These assets are not intended for immediate sale but are used in the day-to-day operations of the business to generate income over the long term. In contrast, current assets are resources that are expected to be converted into cash or consumed within a short period, typically within a few months or within the company's operating cycle. These include stock, trade debtors, money owed to the company by customers, and cash held in the business. For example, a retailer's stock of clothing or electronics is classified as a current asset because it is intended to be sold within the near future to generate revenue. Current liabilities, on the other hand, represent the company's short-term financial obligations that need to be settled soon, often within a year. These can include bills such as trade creditors, money owed to suppliers, short-term loans, or tax payments that are due. For instance, a business might have a large order of raw materials to pay for within the next few months. This outstanding payment is considered a current liability. The difference between current assets and current liabilities is known as net current assets, or working capital. This figure is crucial as it indicates whether the business has enough short-term assets to cover its short-term liabilities. If current assets exceed current liabilities, the company is in a positive working capital position, meaning it should be able to meet its short-term obligations. Conversely, if current liabilities exceed current assets, the business may struggle to pay its immediate bills and might need to find additional financing. Shareholders' funds reflect the total investment made by the company's owners, including the money initially invested by shareholders through the purchase of shares, share capital, and any profits that the business has retained over time rather than distributing as dividends, retained profits. Reserves also form part of shareholders' funds and can include money set aside for specific purposes, such as reinvestment in the business or future expansion. For example, a company may have issued £100,000 in share capital when it was established, and over time it might have retained £50,000 in profits, creating a total shareholders' fund of £150,000. In addition to the funds contributed by shareholders, a business may also have long-term liabilities. These are debts or financial obligations that are due to be repaid over a period longer than 1 year. Examples include long-term loans or mortgages. For instance, a company may have taken out a 5-year loan to purchase equipment. This loan is classified as a long-term liability and represents money that will be repaid over several years, rather than within the short-term period covered by current liabilities. Capital employed refers to the total amount of money that has been put into the business from both shareholders' funds and long-term liabilities. It represents the total resources available to the business to generate profits. In simple terms, capital employed is the sum of the investment made by the owners and the funds borrowed over the long term. For example, if a business has £200,000 in shareholders' funds and £100,000 in long-term loans, the total capital employed in the business is £300,000. This figure is a key indicator of the scale of the business and the resources it has at its disposal to operate and grow. The statement of financial position thus provides a comprehensive overview of the financial structure of a business, helping stakeholders understand its long-term stability, short-term financial health, and overall investment strategy.